Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our econ show, and we're breaking it up into the normal 5 segments. But in the first segment, we're going to talk about the World Bank because they cut their estimates on growth, and we want to look at, okay, well, what are the new estimates and why we think there's still more downside risk based on some of the underlying pieces being central banks raising rates, where inflation is, where economic growth, and what those leading indicators are really showing, to then wrap up with a update on Russia, Ukraine. Then in the next segment, we're going to go into the U.S. consumer credit and how that has really surged to a new record. And what does that mean? Because we've seen credit go back up. There's always, the U.S. has always been a big borrower, but why? And how is that going to impact consumption and GDP going forward, leading into what comes next for the U.S. consumer as we continue to see some of this weakness, leading into some of the problems that are starting to emerge on the housing front. Then we got the notice today that the ECB is going to end quantitative easing starting in July. So we're going to talk about why is that the case and what are some of the indicators of that. And then we did get some more Chinese data, and it remains sluggish. And when you look at the differences between 2020 and 2022, as they come out of the lockdown, you can see that this one is coming much slower, and why some of those issues are going to continue to persist. So with that being said, we want to jump right into what is happening with the dangers in the World Bank. And here's when you look at inflation and slow growth are putting the world economy at risk, with the World Bank cutting its 2022 forecast from 4.1% in January, which obviously we thought was crazy, to 3.2% in April, which we still thought was too high, to 2.9%, which is the most recent, as food and energy prices and supply disruptions and credit central banks tightening continue to become the focal point and the forefront of the issues that we're continuing to see. The problem is, when you look at a lot of these estimates, especially on inflation, there's this peak aspect and then this immediate drop off. And one of the things that we've been very adamant about from the beginning is the pervasive, underpinnings of stagflation, and why we're going to see that pressure point, and then things really stay at this really problematic level, which again is going to become an underlying issue when you look at the problems underneath and why that remains the case. So here's where we start to break down how they got to this point. The U.S., when you look at 2022 final, they've taken it down by 1.2%. Euro area, something similar. The problem is with the Euro area and some of these other places, they still have growth. They still have this real GDP assumption. And as we've been talking about, the Euro area continues to see and remain in a recessionary track, which is something that's going to hit this year, not next. And when you look at, the U.S., you can say, is it Q3, Q4, Q1 of next year? That's just a point of when does the consumer give up the ghost in the U.S., because the consumer is over 70% of GDP. So as the consumer goes, so does the U.S. economy. But there's also that underpinning of, okay, well, if the U.S. economy weakens, consumer weakens, if the developed world weakens, what does that mean for emerging markets as we have more upside pressure to their central bank rates, to Fed funds, as the U.S. Fed fund rates goes up, more pressure to their borrowing ability, and again, to show where the stress is going to continue to come through. And we have a chart just looking at some of the pressure points, especially when we're considering it the crude side and the oil and gas side, because when you've seen this massive rate of change in crude pricing, there's typically a follow-on recession, because especially on the emerging market level, they just can't tolerate this level, not so much on price, but just the rate of change in which it is happening as well as price, which is going to force a give up in subsidies, and then layering in that little piece on food stress and those food problems, again, puts that downside risk still well in play as we go through the summer months. And this is just some of the heat maps that we've seen in terms of some of the assumptions on the predictions. And you can see here that they still have Europe at growth. And I can't stress enough on how we do believe that is a big problem, as well as India and China, when you're looking at some of the assumptions and look at some of the pressure that remains in the system, especially within that Asian continent piece where the pressure is mounting on the inflationary front. And if you think about China, and we'll talk about this more in segment 5, but there's a lot of problems in terms of not only the real estate side, and the bank leverage issues, but also the export front, because exports have continued to come down. Now, they did increase this past month, as we said they would, because as they come out of the lockdown, there's that backlog, so they should see those exports increase. But when you start looking at some of the leading indicators, being South Korea, Taiwan, some other ASEAN nations, you start to see that slowdown that's continuing to remain a blight on kind of where global trade is headed. Now, when you look at the cumulative increases in G7 policy interest rates and peak to trough falls, you get an idea of what this really means. So there's never going to be a perfect relationship, but as aggressive interest rates hiked in G7 countries, they've been associated with a steeper drawdown in GDP growth. And now that the notable exception of this is COVID, but it's important to look at the fiscal and monetary response to COVID that helped avoid the recession. And I think the bigger issue is when you look at some of the problems as they come through, you can see that there is going to be that pressure. Now, even if we eke out some growth in some key areas, there's still that downside risk, because as developed market that G7 countries go, that again is going to have that knock-on effect, and the pressure will mount on the emerging market front. Now, this just puts it into perspective, the amount of countries that are seeing an increase in rates. And as we had a record amount of rate cuts come March of 2020, you get an idea that we've also had a record amount of rises come this year, in so far through 2022. So, when you look at what is happening, India raised rates again. You're continuing to see countries try to get back in front of inflation, which again, as they raise rates, that's going to put more of that pressure to come. And this just kind of puts into perspective again another level of problems that we're seeing on the emerging market trade balance. And this is what we're talking about with the export side, because exports continue to weaken as you see this come down. Again, that's going to put downward trajectory on their economy and their GDP growth, because exports are such an integral part to growth, which is why we continue to see some of these underlying pressures on the emerging markets. And as, again, that trade continues to come down, you can see it's obviously still above pre-COVID, but as subsidies go away, as pressure mounts, because they also cut rates. They issued fiscal policy to be stimulative. Now that is coming back, and the fall is going to be a much harder at this point than I think what the rise really was. Now, when you start just looking at the rate of change, so going back to the 1970s, you see typically when you see an oil price spike at this fast of an annual rate, there's rate of change, and then again, there's typically a recession associated with it when you get this big spike in activity in that crude pricing, which I think is very important when you look at this rapid rise, and what is that going to mean for, again, pressure not only just on the economies, but also the underlying consumer, given gasoline and diesel pricing, as we've talked about in the EIA show. Now, all of this is happening with the central banks. What does the central bank really have to do with it all? And here's where you see that the tighter financial conditions, which again is increasing the cost to not only just the corporations, but also the consumers, which then reduces the amount that they can invest in CapEx, R&D, as well as hiring new employees. So when you start thinking about the real rates are negative in emerging markets, you get an idea that there's still more policy tightening to go. So even though we've already seen tightening, we've already seen central banks increasing rates, we've already seen financial conditions tighten, this is just putting into perspective how there is going to be more to go. And that's why you're seeing fund flows, and the bond outflows have continued to accelerate, especially in the emerging market level, because the view is that rates rates are going to go up. And again, as yield and price is inverse, that is pushing people to sell down and reduce their exposure to the emerging market side. And the credit cycle is turning in general. And this is just looking at the US because it's important to look at the net charge-off rate of commercial and industrial loans, where you're still seeing that pressure on the spreads. And we've yet to really see what we think is going to be the bigger pain when you start seeing some of these charge-offs and you start to see the non-performing loans, the bad debt expense starting to go up, which is again going to be a drag on some of the underlying balance sheets and the ability to lend. And one of the key pieces, and this is not just a U.S. story at this point, is when you look at the residential property prices, which have gone up in price, now coming back down. That's going to create an asset problem. Like what is the collateral that is on the sheets? What is the bank looking at when you're, okay, well, how many mortgages have you written and what is the value of that collateral? And as that shrinks, that's when all of a sudden your leverage ratios get blown out, as we saw in the US financial crisis when everybody assumed that there was a leverage ratio of anywhere between 12 and 15 times, and then all of a sudden it's 25 to 28 times. Now, you could say that there were a lot of instances where you could see it was clearly the case, but again, you're getting the idea that you can get these extremes and they can happen fairly quickly, especially when you look at potential runs on banks. And just to put a run on a bank in perspective, if you're a portfolio manager and you have a winner and a loser, well, if typically your counterpart is a bank, and let's just use Lehman for an example. So when I was at Morgan Stanley Investment Management, we had multiple total return swaps, interest rate swaps. So when things started to get a little hairy, we took our winners off and we figured, all right, well, we're already losing here. It's already at the max. We'll let that ride. Well, when we close out the winner, we take our money, but the counterpart is not allowed to close out their winner, so which is a loser for us. So even though in theory, when the expiration date and we have to pay Lehman or just the counterpart, they will get a cash infusion. The delta between that is where you can see that cash shortfall, which again became a much bigger situation during the financial crisis, and how you can get a rapid run on a bank because a lot of people will close out their winners, let their losers ride, and the gap between when the losers pay out, which is when the counterpart will receive cash, becomes a problem. So when you look at UN food and agriculture, global food price, the tick down slightly in May, but obviously that's little slight downtick. Again, more reason why we see a longer move on just the sideways backdrop of stagflation, as we don't see this adjusting. And here's some of the reasons why. When you look at the Ukraine share of world production of sunflower oil, barley, wheat, there's a view that Russia is going to try to make an agreement where they'll allow some product to come out, but realistically, it would take months to demine the area. And there's only a corridor that on estimates can manage about 2 million tons of exports, not the 6 million that is normal for Ukraine, which again would still leave the world short, as the top importers of key food commodities being Tajikistan, Mozambique, Egypt, Jordan, Uzbekistan. And you're getting an idea that these are not the most stable countries when you look at what is their bond rating, and again, why we see more stress on the emerging market level. So when you look at the commodity export boom and the soaring crop and crude sales, you're getting an idea that the Bloomberg Commodity Index is now at an all-time high, and a lot of this is being driven based on more you're just pricing going up, but this is also showing how the U.S. is benefiting because we're exporting more of these goods, where even if it isn't at the same volume level, the value level has gone up exponentially. Now, there is some relief out there, and it's when you look at the shipping index, when you look at the DRAM contract price, and then the fertilizer piece. But one of the things that we've been saying from the beginning is that we are going to crest, and instead of having a steep fall, really see that flat line. And you've seen it where phosphate and potash have remained elevated. Nitrogen prices have come down, but not the other two. Shipping index is always going to fluctuate, and then the contract price for DRAM continues to be a bit elevated. Now, one of the things that we see when we look at the low wage workers, you can see that the share of full-time workers earning less than 2/3 of the median earnings in 2020, the U.S. was at 23.8%. So, and when you think about it, nearly 1/4 of U.S. workers are classified as having low pay, which again is 10% higher than the regular, the OECD nations and European averages. Now, there's a certain amount of caveats in that. That we're operating on dollars. Dollars have a higher buying power than some of the countries that are listed here. But you're getting a sense of just where the pressure is and why we have that disconnect when everyone's like, oh, well, there's a ton of savings in the account. People will still spend. It's like, yes, but that can drain quickly, especially given where living wages have gone and where living costs have gone, and how there was already that stress with a lot of people already living paycheck to paycheck or off of credit, which is now back above pre-pandemic levels. So just putting into perspective some of the different costs that we're talking about, this is, I think, an important one. And this is just looking at Brazil, where nitrogen prices have come back down, back down to where they were, still elevated versus previous. But again, when you look at potash and phosphate, there still remains some of that crux and problem that is going to remain a bigger issue as we look at price and underlying crop costs. Now, when you start looking at the OECD June 2022 economic outlook and inflation forecast, here you can see that there is, again, that drop off in 2023. And we do see some drop off in 23. But the question is, how much of it is a mathematical equation, because you're going to go against larger numbers, so the percentage of change will adjust, but you're still fighting high prices, which is that stagflationary piece that we're talking about. So even if financially speaking the rate has come down, the pain to the consumer is still going to be elevated because you're still going to be fighting it and having these elevated price points. So then when you start looking at, well, what are some of the key pieces? Well, the input costs on the global composite PMI continues to go up, while the output price has started to come down. So the question is going to be, how much of the corporations are going to continue to push through this price, even if they're losing some of that demand? And that's where you're starting to see that gap where consumers are rejecting higher prices. So there's a certain amount that's going to have to be eaten by the corporation. And then there's other pieces that they're going to have no choice but to push that through. And that's when you start looking at diesel prices and other input costs and factory gate prices that will remain the problem. Manufacturing supplier delivery delays have started to improve, and they got a bit worse. And now that China is starting to reopen, we should see some of this normalize, which again, we're already elevated now on inventory. We went from a deep, steep shortage to now a steep oversupply, and there's going to be again some of this swing. But as the delivery delays get a bit more normal, that will also naturally pull down some of the PMI and leading indicators, and you'll get a truer sense. And here's just looking at an example of average waiting hours for tankers, bulks, and container ships at Shanghai, still elevated but obviously improving, which is something that we do expect to continue, which will help some of that price and bring some of that product back into the market. Now, when we start looking at ways to address inflation, especially on the energy front, we continue to come back to the nuclear discussion. And we're going to try to have a much bigger conversation and do a show just on nuclear, because when you look at France relying on nuclear power to underpin its energy supplies, there was a big focal point of getting rid of that nuclear fleet and accelerating the shutdown. But now a lot of that has been delayed, and you're even starting to see a bit of a pivot in the commentary around nuclear and the importance of it, given where they are in the backdrop and the cost. And then obviously the question is, what do you do now that you don't have Russian natural gas? But how does the U.S. view it? Because when you start looking at small modular reactors, SMRs, and the build out of a broader nuclear base, what is the favorability, and you're starting to see that pivot just a bit where things are getting a bit strongly or somewhat favor nuclear versus not. It's still very tight. This would start a lot of fights at Thanksgiving dinner, but this is something that especially as we have the newer technology from pebble reactors to SMRs, some of them being together, and the importance of potentially building some of these new facilities out. And then when you look at, who supports what, you can see that independents are becoming increasingly in favor. Now, the Republican side has always been a bit more in favor of nuclear. The Democrats have always been a little less favorable to nuclear, but the independence is really what's going to drive most of that rhetoric. And that's where we have to look at some of the importance of where does that rhetoric go and who is driving it. As the independents look more towards nuclear, we should see that message get embedded a bit more on both sides of the aisle, not just one. And then I think this was good in terms of showing American support. U.S. adults, 51%, more male than female. And then the older and actually younger populations in terms of 55 plus and 18 to 34 support the nuclear capacity. So now when you start looking at the why that is the case, you look at the U.S. reported electricity disturbances by season. And I think this is interesting to see where the disturbances are, and you can see that things have continued to get worse and less structured. And it happens to not only just roll out in terms of hurricane season, obviously, in terms of when there was a bad hurricane. So there's a certain amount of weather shifts, but there's also, we're relying more and more on really a peaker capacity and not baseload capacity. As we take nuclear off or look to shutter it, we take coal offline, and we rely more on some of the renewables that have short cycle gas turbines backing them. But the short cycle gas turbines are on interruptible contracts, which means that if there's a shortage of natural gas, they can be interrupted, again, becoming an underlying problem. Now, exports to Russia have continued to plummet since it invaded Ukraine, which isn't surprising across the board. And the issue is, again, how does Russia account for this, given the shortages they already had on inventory? And this puts a little bit more impetus on some of the things that are happening in the country. Now, when we look at some of the shifts in the assessed control of terrain in the Ukraine, you get an idea that there obviously continues to be broad fighting, but I think it's better to break it down in terms of where the Ukrainians have made progress, but also where the Russians have made progress. So when you look at Severodonetsk, you can see that they've continued to push out, increasing their advancements. When you look at the Russian movements, there has been some pushback from the Ukrainians in Toshvatka, but the other areas you continue to see a lot of push in terms of movement where the Russians have made some headway. Now, this is in the deeper, let's call it east to west. But when you start looking closer to the coast, you can see that there has been some reclaiming of the along the coast. When you look at the oblasts and the areas where the Ukrainians have essentially done what we've been talking about of letting the Russians move in, then coming in and launching counterattacks, forcing a retreat. But when you look at the data so far, you can see that there has still been net gains by the Russians as they continue to dig in, and Kherson becomes very important when you think about where they are in relation to some of the Black Sea and the Sea of Azov. And again, how they've continued, and the Russians have continued to try to block this out. Then there's been a much bigger component where the city has been deemed, not, I don't want to say freed, but essentially the Ukrainians have been able to take control of Kharkiv again. But you can see that the fringes still remain in contest. But in other areas, when you go further into the Donetsk Oblast, you can see that there's continuing to be the movement. So realistically, the Ukrainians are making headway to the north of the conflict zone as well as to the south, but continue to give up some the Russians continue to make advancements as you move from east to west. Now, there is more equipment moving in that will find its way down into these key areas. But again, we see a lot of stalemates happening in this area, which is unfortunate for the loss of life and everything else. But it's also going to be the point of contention where I think you're going to see a lot of the lines shifting back and forth, but realistically not much is going to be net gained over the next few weeks, just given based on the equipment in place and whatnot, and the reason why I say that is because it's going to be difficult to make an agreement on how much Ukrainian grains can get out if they're continuing to be in this stalemate. So that's what we have for you on segment 1. In segment 2, we're going to go deeper into the credit side and cover things in a bit more depth on the U.S. front.